What up? It's January 20th, and let's go over this market alert. There's a lot of stuff to talk about today. Lots of stuff going down in this market. I kind of put this up here on the screen because it's very telling of what's going on. I think it was the most kind of descriptive thing that I could find to put up on the screen. But essentially, we all feel like the little guy today against these big Wall Street bearish firms that are betting against the little guy. And we have to make sure we're smart enough to make the right decisions, not to panic, not to sell these guys our shares. Okay, so when we look at our stocks, we know what we buy. We have conviction. We don't panic when things get rough, especially things that are macro induced, not specific to the businesses that you own. Okay, so let's get started with this. But before we do, of course, please hit that like button, hit subscribe. I hope that you learn something from these videos, that you take something away. We have some fun in the meantime. Okay, let's get going. So let's start with a chart of the Nasdaq, because I think that's the most telling thing for today. The chart of the Nasdaq down 1.30%. What you guys are going to find here, here's yesterday, here's how today starts. And the common denominator is the morning buyers are getting demolished here. They're coming in and they're thinking, yeah, we good. We're going to buy this market. They're getting demolished. So don't be that guy. Don't be that lady that's getting up in the morning, buying the market because you think it's bad. Market goes good and you think you're a genius, and then you get crushed. Okay, I've been backing off a little bit of buys because I think there's a little bit more pain to come, and there's a lot of things that we need to look at. I'll be going over those in the market forces when I talk about market forces, and then go from there. Okay, now moving on. Lots of talk about interest rates, and for that we look at the U.S. 10-year bond yield, and it's been pretty steady. This is actually quite surprising. Today it was about 1.84, 1.84, 1.83, and it's fallen below 1.8, which I think is positive. But you see here, this is the start of today. Pretty steady. Not a lot of moves here. Kind of consolidation. Nothing too wild there. So the sell-off today is a little bit confusing to me, but I'm kind of equating it to company earnings and also the geopolitical tensions that are out there that are heating up. We'll be talking about those in a little bit later. And of course, we'll move on to the price of gas, which is also another driver of the economy and driver of the market at the moment at $84 a barrel. So this is pretty high, pretty much near a year, 2-year high. And you have to understand with oil, okay, a lot of people blame oil on the president, on whoever, government, and you have to understand that this is a supply and demand equation. Demand is high. Absolutely. Supply is low. We're still sitting with these providers in the Permian Basin and the Gulf, the American providers, at about 50% production capacity. We're still sitting about there. I look at the rig counts every day. Not all the rigs are on. Okay, most of the rigs are trickling oil because they can't shut them down all the way because it costs too much to kind of power them back up. They trickle down to cut the supply, okay, and in hopes that the demand stays high, supply lowers, the price of gas goes higher, and they make a ton of money, okay. But there will come a point in which these oil suppliers, especially the American oil suppliers, are going to be too tempted, too enticed to increase their supply and actually start pumping more gas to return more money to their shareholders. Remember, that is their number one concern. Not for the overall well-being of the American consumer. They don't want to make gas cheaper for the American consumer. Their number one concern is their shareholder and returning money to their shareholders via dividends or share appreciation. Okay, that is their number one thing. Okay, so like I said, $90 a barrel is that point in which I think they will increase production. They may not, but that's my personal thought. Okay, now remember, for these companies to be profitable, they need to pump gas at about $35 to $40 a share. That's about their break-even point, depending on the company. I think there's one or two that are at 30 because of the technology they have, but they're making double that. So they've been making a killing. This is why energy names have been the winners in the last year. I want to move on and talk about the important stuff, market forces, okay? What's going on with the market, the bad, the good. We're going to talk about the bad first, okay? Because I think that's the most telling stuff. This is what people care about today. And we'll start with the expectations of the Federal Reserve and rate hikes. And, of course, how many rate hikes are already priced into this market? Hard to tell, but I'm going to go with 4 rate hikes are priced in to the market, okay? I know you can't see the 4, but right there, 4. So when we're talking about rate hike expectations, you'll hear a lot on the news about certain analysts saying, "Hey, expect 6, 7, 8 increases this year." I think that's far-fetched, guys. I think that's just too much. it could be the case, but depending on the amount of that they increase the rate, if they're increasing the rate by 0.25%, then yeah, expect them more often. But if they are trying to shock the market with half a point or a whole point of interest rate increases, then yeah, you're not going to have 6 or 7 because the rates are not going to 4 or 5%. That's just too burdensome on our economy, which still has growth. People still have money to spend. Okay, so that's essentially the story with the Federal Reserve and the rate hikes. Let's see what happens. Okay, the more the market prices in a more and more bearish or hawkish Federal Reserve, the easier it is to beat the expectation. I mean, if something goes down with geopolitical tensions, China, Russia, whatever, and the market needs to turn less hawkish and turn dovish, what's going to happen is that expectation is going to go away, and then stocks are going to go higher because now the Federal Reserve is more supportive of these markets. Again, okay, now the other story here, lingering inflation with supply chain issues. We all know about this stuff. It's in the news, all this stuff, okay? But it's not only in the U.S., it's abroad as well, all over the world. And the China supply chain story is one of the most important things, okay? When we're talking about China supply chain, you have to understand that when things come from China, they're not coming steadily. China has a zero tolerance policy towards the Roni Rona, the Obi Crony, whatever you want to call it. In Macau, when I read Macau news, you can tell when they're at a lockdown because one person tests positive, they lock down everybody when one person tests positive, and that disrupts business, disrupts supply chains. So again, we'll keep an eye out on that. All right. Now, geopolitical tensions. We talked about China, France just came out. Let me show you this article here. The French Parliament just came out and said, "Hey, we're gonna label China as a facilitator of genocide against the Uyghurs." Sorry if I'm not saying it right, the Uyghurs, and that's a brave thing to say from one country to another. Is it happening? Yeah, I'm sure it's happening. But for a country that has deep ties in supply chain and trade with China, very brave thing to say. And who knows how this is going to escalate? I'm sure it's going to escalate in some way. The Chinese government is not going to like this. And of course, we move on to the potential Russia in Ukraine conflict. We got some new news today, and check this out. So the president is saying, "Hey, yeah, I think Russia will invade. I think they will, and there's going to be some conflict there. Who knows how much is going to escalate or de-escalate? Who knows? But you have a ton of troops there, tanks. I mean, this looks like old school Soviet era." Kind of, troop movements. I mean, I used to be a cavalry scout in the Army. I kind of know a little bit about those kind of movements and tank movements and things of that sort. It reminds me of these videos I used to see when I was a cavalry scout when we're thinking about, tank movements and maneuvers and stuff like that. Very, very similar. So yeah, again, we'll watch that because that will affect the market. But one thing to note about these geopolitical events is that most of the time they're a buying opportunity. So when you see these events, and you see how they unfold, most of them, about 90% of them, will turn out to be a buying opportunity, if not all of them, okay? So pick carefully in these times, okay? Because you never know how long it's going to last. But again, every single geopolitical event has turned out to be a buying opportunity for the market, okay? So we'll move on to number 4. Some big dogs are showing that they're vulnerable. An example, the Netflix earnings. So Netflix reported earnings today. Let's go over that chart real quick. And here's the one-day chart of Netflix, guys. I mean, this is horrendous. It closed at 508 and lost 20% of its value after it reported, down to $405 a share. I mean, look at this dip. It reports earnings right here, and then it just goes straight down. Horrible. But again, it's the expectation. Netflix had an expectation of 6.9 million subscribers to be added to their subscriber list in Q4 of 2021. And my thought is on that is, who comes up with these numbers? Who comes up with 7 million subscribers for growth for Netflix when you have Disney Plus, Hulu, HBO Max, Discovery, Peacock? You have a ton of competitors out there that are new to the market, that people are liking, that people are subscribing to. I wouldn't be surprised if you're one of these people that their subscriber bills are not higher than your cable bills. And if you don't have cable, you remember the cable bills, they're probably higher now than they used to be before with your cable bill. So, of course, it was only about 2.5 million subscriber growth way under the expectation of the market. So Netflix gets punished, meaning the overall market gets punished because Netflix is a $225 billion company. Okay, now let's move on. And here's a couple quick points here on the bad here. The tech stocks are hated. The Nasdaq is hated. The Nasdaq is probably the recipient of more and more and more punishment, but you have to keep your eye on the ball, guys. You can't just sell because you think it is. If you have stocks in the Nasdaq and they're down 30, 40, 50, 60, 80% from their all-time highs, it's too late to sell them. Too late. You should have sold them when they were roaring higher and they were trading at crazy sales multiples and so and so forth. Kind of like a DraftKings. Should I have sold DraftKings in the 70s? Yeah, you bet. I should have. But I have a longer time frame. DraftKings still has a huge path or a huge path to profitability when it comes to expansion in all these states that still don't have it. I mean, remember, DraftKings is only profitable in, or not profitable, but only operating in like 10 states. We still got a lot of room to go there in DraftKings, okay? And I'm going to keep buying that stock the more it goes down. So, moving on here. Companies that are not profitable have been exiled, a la DraftKings. Not profitable, being exiled, fine by me. And then retail investors appear to have no remaining dip buying power. I ask, where are these people that are like, to the moon, stocks only go up, buy everything, buy Tesla, buy this? Where are you guys at? I don't see you guys. I need to see you guys for me to feel more comfortable, okay? Don't see you guys. That's not a good thing. And then volatility is high via the VXN. If I show you guys here the chart of the VXN, this is the VXN, which is the measure of the volatility of the Nasdaq 100. And you guys can see here, I mean, it's sort of flying all over the place here over the last month. It's just flying and making these wild swings. Not good for the market when volatility gets this high and a whole index, a whole 100 basket of stocks moves in that certain way. So yeah, not good. And now moving on to the good, because I don't want to take too much longer, but the earnings. Earnings are the biggest drivers of a company's stock price, or at least they should be. There's, of course, some stocks out there that do not move on their company, right? They move on things that have nothing to do with the company, kind of like a GameStop or AMC. Those stocks have no relation to their business and how overvalued, undervalued. It's just essentially like another Bitcoin or Ethereum. It has nothing fundamental behind it. But 99.9% of companies out there will move on their earnings. We're focusing on earnings, and we think that they're somewhat good. Okay, the earnings are somewhat good. Companies are still beating at about a 70% rate as opposed to an 85% rate a quarter ago. But they're beating at a rate of less percentage, right? About 8% beat rate as opposed to about a 15% beat rate in Q3. So it's a very mixed picture. I'm still saying it's good because the companies that I own have reported good things. If you look at Corsair, they just reported that, hey, our year-end revenue will come in at the high range of our expectation, which is fantastic. That's good execution. That's what I like to hear. So I think it's a mixed picture for earnings towards the good. Now, here's another thing. I think this is very interesting. The U.S. economy is still strong, and we're looking at Signet Jewelers for that when they reported this morning. Let's look at that real quick. And for those that don't know, Signet Jewelers is K Jewelers, Sales, and Jared. That's pretty much what it is. There's some other stuff here, something Direct, Rocks, Box Jewelry, and what is this? H. Samuel Peoples. Yeah, I don't know what that is. But essentially, K Jewelers, Sales, and Jared. And you guys are going to be surprised at this number. Check this out. So here in their earnings presentation from this morning, very telling here what happened in this item right here. Q3 same-store sales up 18.9% in a quarter-over-quarter basis. Unreal. Unreal. And 37.2% from Q3 2020. So 37% increase in same-store sales year over year. That's fantastic. Everybody who's complaining about inflation, everybody, and I bring out my remote because I want to grab something. Everybody who's complaining about inflation must have been going to Signet Jewelers to buy gold, jewelry, diamonds, whatever, because they somehow believe they're protected against inflation. But I don't think that's the case, right? I'm of course talking in generalities, but I don't think that's the case. I think people were buying jewelry to gift to others during Christmas, during, Black Friday, whatever it may be, and their sales were extremely strong, which shows the buying power of the American public is still there and savings rates are good. People have spending money and they have spending power. This is very positive for the overall economy. That brings me to my next point here, which is employment remains strong. Too many jobs, not enough people. Okay, we need to do some automating right there, right? And then the individual savings numbers are still close to all-time records highs. And individual savings, meaning savings accounts, are still in the United States near record highs. So spending power is strong. And then the next point here is big mega cap tech still holding this market. However, if that falters, watch out. So what I'm talking about here is look at the numbers here for the Dow Jones, 34,000, S&P almost 5, Nasdaq 14.1. These are still pretty high numbers, but there's a lot of rut under that surface because these are more heavily weighted to the big company names, the big dogs. Google, Apple, Amazon, what else? Microsoft, Meta, which used to be Facebook. These guys are holding up this market, but when they don't, when they go down, they will take the overall markets with them. My hope, of course, is that that money rotates from the big dogs into the little dogs in the Russell 2000 and the Nasdaq. That is what I hope for, okay? And that is essentially what we've been doing in building our portfolio, betting for that kind of cycle into those names. But we will see. Hopefully it happens. If not, we'll see. And then here to end it, nothing else, okay? I put here a big red block because essentially I want to show the deficit between the good and the bad. There's a lot more bad than good in this market. So this is why the markets are not doing well, while they will probably still go down. But at the end of the day, in conclusion, we need to be patient and remember that panic is not a strategy. You want to be picking stocks when they're doing bad, not when they're doing well, so you make the maximum amount of profits. The way that we do our business here and how we manage the account is we pick stocks when they're at a bargain, not when they're just okay deals or whatever deals. Okay, so that's it for tonight. If you guys have any questions, please reach me in the Stock Gladiators Discord. Also on Instagram, follow me there for all my moves. DM me there any questions. I'd be happy to help any of you. Okay, guys, peace out.